the Graham and Dodd highly celebrated value investing book titled as Security Analysis. So Warren discussed this at the Columbia University event to commemorate the 50 years. And the typical argument when people cite successful investors like Buffett, etc., the typical argument by the academicians is that this could be a result of random events also, which is absolutely true. And we'll go through this thought experiment to see what is the result of random success. Okay, so imagine in 1983 there are about 225 million Americans. So that's the example Buffett has given. Since we are referring to a study, we are sticking to that example. We could have given an Indian example or any other example. So about 225 million Americans start out on day one with $1 in their pocket. And the model is that every day at sunrise, they flip the coins. And whoever calls the coin correct, the coin flip correct, which means somebody calls it head or tails, whoever calls it correct, gets the $1 and the other guy loses the dollar. So they are matched up one-on-one with various people and the process starts. Then on second day again the winners wager against each other and keep going to the next level. So by end of day 10, the winners, there are about 2,20,000 winners, and they have been earning, doubling their money every day. So they are at about $1,000, starting from $1. By the 10th day, they are $1,000, and rest of the millions of Americans are out of the business. Okay, and now they are looking extremely successful, and obviously it goes to the ego, and people start talking about how they have this coin flipping technique which gets them to win continuously every day. Okay, so and that goes on for further 10 days, and by now all of these guys are millionaires. There are about 215 of those who have gotten 20 correct coin flips in a row. So on 20 continuous days, they have flipped the coin and called it right, whether it's a head or a tail. So and they've ended up with $1 million, or slightly more than $1 million. Okay, so this is the explanation of a lot of rich people who would get to their being rich purely out of luck and no skill. Okay, now since this is a random process, the expectation is that those 200 odd millionaires would be spread all across USA. Okay, and they would be randomly spread across USA. However, by end of the 20th day, if someone finds that all of these 215 millionaires are all coming from one single city, then definitely questions would arise whether this process was indeed random. Okay, so this is what Buffett is citing, and he says that there is a group of people who are the value investors who all originate from an intellectual place called Graham and Doddsville. So we were just summarizing that that value investors can beat the market systematically over long periods of time, and there is a solid reason why it can be done, because they work on a certain logic of establishing value. Now we look at some more evidence. This was a study carried out by Louis Lowenstein of Columbia University over the period 1999 to 2003, and in 2004 it was presented. To start out, he asked a knowledgeable investor who himself runs a value investing fund called Sequoia Fund, which we had cited in the previous study of Buffett, and he asked Mr. Goldfarb for a list of prominent value investing mutual funds whose information is publicly available, and he was given these 10 names, and without anyone having looked at what their records were. It was just the process they followed, and that's how they were chosen. Now at the end of the 1999-2003 period, we see that the S&P 500 over that 5-year period has delivered a negative 0.6% return, while these funds have returned anywhere from positive 2.7 to as high as a 17% returns. So that's, and with most of them ranging in 10 to 15% returns. So we see that these are able to beat the market by more than 10%, okay, and consistently. So there is a difference between value investors and others. It's not a random result. There is a systematic process. This study was carried out again and again 2 or 3 times, and always it has given consistent results like this. Now look at the alternative investment markets. Now the aforementioned studies were based on the listed equities market, where there is a lot of information available. Markets are being tracked continuously. There are a lot of disclosure requirements by SEC and other regulatory bodies. So very, very large amount of information is delivered to all the people at the same time. A very large number of analysts are analyzing the securities daily. Very sophisticated investors with large amounts of capital are investing daily and trying to arbitrage away and obtain any kind of advantage. And even in such efficient markets where the expectation should be to have that the efficient market hypothesis is true, we see that study after study is able to find ways of beating the market. Okay. Now in contrast, look at the alternate investment markets. They do not have such disclosure levels or such regulatory overseeing. The information is very, very low. The quality of the information is also low. There aren't a lot of analysts tracking these markets, and there are not a very large number of investors tracking these markets. So the chances are high that these markets a priori are inefficient. So it's an expectation that they are less efficient, and thus they should provide even more opportunities for providing high risk adjusted return. One of the prominent examples during the 80s, 90s and 2000s was David Swensen of Yale Endowment Fund, who generated very high returns by allocating the Yale funds to alternate assets. Of course, because that study has been popularized, those returns have been popularized, a lot of other endowments and other large institutional funds have started allocating heavily to alternate assets. So it need not be true a priori anymore that the alternative assets markets are inefficient. In fact, they could be inefficient in the other direction too. Okay. So, however, if you ask across alternative investment markets across the globe, the chances are still high that the value investing principles should be able to uncover pockets of inefficiency, which should provide high risk adjusted returns to the savvy risk averse value investor. So what is this value investing? Okay. First of all, it is a mindset. Value investing is a mindset or an attitude which focuses on safety first. It is highly risk averse. The first principle of value investing is not to lose capital. So you look at all the ways you might lose money, so all the actual risk factors rather than some theoretical factor like volatility. You actually look at ways in which you can have loss of capital in a specific investment situation, and you make sure that either those risks are reduced, and once those risks controlled or understood or reduced is when you start looking at whether sufficient return is being generated. Now again, sufficient return is not related to how much risk you're bearing. It actually is related to what is your opportunity cost. So your expected returns should be higher than any other place where you can put the money. So if I have to summarize, value investing is the process of determining the intrinsic value of an asset and buying it at a significant discount to it while maintaining a large margin of safety. Okay. How do you calculate intrinsic value? So use John Burr Williams' theory of discounted cash flow. So you present value all the expected cash flow either from holding the asset or while exiting or the salvage value of the asset, and that present value is the intrinsic value. It's not a precise number, but it's a range because there are a lot of estimations you have to do on the cash flow, the estimations you have to do on the discount rates, and that's how you calculate. Okay. Now, so it's an estimate, it's a range. Since you don't know the precise value of intrinsic value, you have to have a margin of safety. So you want to not pay the exact intrinsic value which you calculate, you want to have it at a